The Fed15 podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our host are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve, and Katelyn Murray is a financial advisor through Raymond James Financial Services and Director of Advisory Services here at Serving Those Who Serve. Hello, everybody, and welcome back to a very special episode of the Fed15 podcast presented by Serving Those Who Serve. Each week, we discuss the latest news and info that feds need to know in 15 minutes or less. So whether you are a seasoned federal employee or whether you're just starting out in your career, Fed15 has got you covered. So grab your coffee, kick back, and we will tell you what you need to know but might have missed throughout the week. We are your hosts. I am Katelyn Murray, and I am joined by the fabulous Miss Chelsea English this week. Chelsea, how you doing?
Doing great. Excited to be here. Looking forward to getting to join you on the pod today.
Awesome. Yeah, absolutely. Now, I know you got to I was a little bit jealous because Chelsea, as you guys know, if you're a veteran listener of the podcast, Chelsea got to join Dan. She filled in for me a couple of weeks ago. So she may not be a totally new face for some of you out there. And I was a little bit jealous because Chelsea and I work pretty closely together here at Serving Those Who Serve. We sort of tag team on a lot of client relationships, and she's a really great advisor and just a wonderful part of the team. So I'm so excited to have you on today, Chelsea.
Thanks, Katelyn. I'm excited to be here. Obviously, we do work really closely together, and it's fun to get to do this different part of work that we don't normally get to do together. So I'm excited to be here.
For sure. Yeah. Always good to be invited back. Means, last time went smoothly. We didn't get any emails, so that's good. Awesome. Well, we have some exciting kind of news for you guys today. I know that the TSP fund updates and performance updates are always a big hit with our listeners. So Chelsea will be going over those here in a few minutes. But before we move on to kind of our TSP rundown, our monthly recap, to see how March shaped out for the TSP funds, I wanted to give an update on a topic that we have featured before on the podcast, and that is the USPS health plan change. Now, it's been quite a number of episodes back that we covered this shift, but basically our USPS retirees, employees, and their families who are on family coverage are going to be forced to switch from FEHB to the new Postal Service Health Benefits, PSHB program, and that will start next year. We do have some more details on that as of now. There is going to be a special enrollment period that actually opened up on April 1st. So it is currently underway, and that enrollment period is allowing folks to opt in for Medicare Part B. Now, that special enrollment period only applies to USPS retirees who kept their FEHB coverage in retirement but did not enroll in Medicare B at age 65. You should have gotten a notice about this in the mail in March. So hopefully this isn't the first that you're hearing about it, but if it is, you definitely are going to want to check that out if you are retired through USPS and if you are at least age 65. Those are kind of the two. That's kind of the group of folks that this is applicable for. Now, if you do decide to enroll in Medicare Part B during the one-time special enrollment period, which is going to run from April 1st, as I said, through September 30th. So you have quite a bit of time to decide. The late enrollment penalty for Medicare Part B is waived. So just as kind of a refresher, normally the deal with Medicare Part B is once you retire, you've got a special eight-month period to enroll in Medicare Part B if you are already 65. If you do not enroll in Medicare Part B, then there is a 10% penalty that goes along with that if you ever do decide to opt in the future. So if you are older than 65 by just a couple of years, that 10% penalty can be pretty steep. So we are very pleased to see that during this one-time special enrollment period, you can avoid that penalty if you do want to opt in for Medicare Part B coverage. Now, if you do decide to enroll, you will need to maintain Medicare Part B coverage in order to keep your Postal Service health benefits plan beginning January 1st of 2025. However, you do not have to enroll in Medicare Part B in order to keep your health insurance when you're switching. So it sounds like the two things that I just said there are a little bit contradictory, so we're going to unpack it a little further. As a retired U.S. Postal Service employee, you do have to switch from FEHB to the Postal Service Health Benefits Program. They are opening up this special enrollment period from April 1st to September 30th to give you the option to opt in for Medicare Part B if you did not opt in previously. You don't have to, and if you don't decide to opt in, then the Medicare Part B requirement is not mandatory for you if you are already retired and over 65. If you do decide to opt in during the special enrollment period, then you will need to continue that Medicare Part B coverage indefinitely in order to keep your health benefits. Now, for USPS employees who are retiring this year or later, you don't get the option. You will have to opt in for Medicare Part B, and that Medicare Part B enrollment will be required to keep your Postal Service health benefits coverage in retirement. But if you are already retired under the USPS, then you do kind of get the option as to whether you want to add Medicare Part B on or whether you don't. If you have any questions on that, I know this is kind of a particularly hairy issue. There's kind of a lot of nuance to it. Feel free to reach out to us at askstws@stwserve.com. We're happy to kind of field those questions and get you the information you need to make a good decision there. But definitely, if you're 65 or older and you are retired under USPS, I would take a second look at Medicare Part B during that special enrollment period through September 30th. So, Chelsea, let's talk TSP. I love our little monthly TSP recaps. I think a lot of our listeners do as well. And it's nice to just kind of keep up with what's going on in the TSP this month.
Absolutely. So, let's talk a little bit about greater market context here. So looking at the first quarter of 2024, the equity market saw a significant rally with the S&P 500 index reaching new all-time highs 22 times in just 3 months. So this impressive performance was driven by a few factors. Companies reported strong earnings, interest rates decreased from their previous highs, and employment numbers were looking good and robust. In March, all 3 stock funds in the TSP showed gains. The I fund outperformed C and S funds, while the G fund had the least favorable performance. The C fund, it really stands out as the top performer for 2024 so far, with a year-to-date return of over 10%. To put this in perspective, as you know, Katelyn, equity markets typically see annual returns of around 10%. So achieving this in just 1 quarter is pretty remarkable. And looking at year-to-date numbers, all TSP funds except for F fund are positive for 2024. This aligns with the strong market performance of equity markets and reflects the impact of interest rate sensitivity on the bond market, as seen in F fund's performance. So digging into the numbers, C fund for March, 3.22% return. And again, that year-to-date number, 10.55%. For S fund, March, 3.33%. Not as great as February's 6.03% return, but still, year-to-date return of 6.92%. I fund, March's best performer, again, 3.36% with a year-to-date return of 5.95%. F fund, 0.87% return for March, which is up from February's negative 1.41%. And that's a year-to-date return of negative 0.74%. Like I mentioned in last month's TSP recap, F funds performance is largely tied to the high interest rate environment that we're seeing. And the Federal Reserve continues to indicate that they're not cutting interest rates anytime soon. And bonds have an inverse relationship with interest rates. So when rates go up, bond prices and consequently the performance of bond funds like the F fund tend to fall. And then lastly, wrapping it up with P fund, really held steady from February. So March returned 0.34%, up from last month's 0.33%. And that's a total year-to-date return of 1.05%. Yeah. So, remember that markets move according to what's predicted to happen in the future, and nobody has a crystal ball. So that's why it's so important to stay disciplined with a good investment strategy to withstand, unpredictable short-term market swings. And Katelyn, just like we say to clients all the time, it's not about timing the market. It's all about time in the market. And keep in mind that retirement is not the finish line. It's just the beginning of what we hope will be a long, happy, and healthy next chapter.
Absolutely, Chelsea. I could not agree more. I think there's 2 points there in your kind of recap that I want to call out. One being the often quoted phrase, it's not timing the markets, it's time in the markets. And I would say if you are one of these folks who, when we saw the pullback in 2022, I know it was a rough year, it beat everybody up, right? Markets down over 20% as a whole. But if you were one of the folks who kind of got scared off into the G fund during that time period, and you were sort of waiting to get back in, you've missed it. You've missed that mark, because we have seen that recovery, especially with that impressive C fund return of over 10.5%. So if that is you, there is no shame. We are all learning, but I might suggest an investment strategy, a long-term investment strategy that is going to allow you to weather difficult markets, because they will come again. Typically, a bear market happens once every 7 years on average. So, if you're still working, but even if you're in retirement, as Chelsea said, it's not the finish line. It's just the start. And so even in retirement, we hope that you do see another bear market, because it means that you will, have a long, happy, healthy retirement. But we do need to plan for that, and shifting money between these funds and the TSP. We don't believe that to be the best strategy for long-term wealth generation. The other thing that I wanted to just comment on, Chelsea, was, the concept of retirement as a long time period, right? Often I think our feds get really focused on, the date that they're going to turn in that 2801 form.
Absolutely.
And, put the keys on the table, but you have to have an investment strategy that is going to allow you, if you're retiring in your 60s, to have income generation, to have funds to keep up with inflation in your 70s, your 80s, your 90s, especially as, healthcare is making all of these advancements and expanding our lifespans. We really need to plan for that. Back in the days of, the heydays of CSRS, it was a lot easier to plan for retirement. Now it's a little bit more complicated, because we have more time to kind of live off of that portfolio. So coming back to that kind of image of the three-legged stool for retirement, right? You got your pension, you got your Social Security as a FERS employee, right? And then you've got the investment portfolio. And that investment portfolio is really going to allow you to keep pace with inflation, to hopefully outpace inflation, and to keep your purchasing power, so that in those twilight years of retirement, you have the empowerment to make the decisions that you want about your health care, about long-term care, if you need that, and about giving to your family, about your estate planning, right? Helping the next generation, maybe even the next generation, the grandkids. So I know it sounds like a lot because frankly, it is a lot. So if you need help, feel free to reach out to us. We're always here to help. Check out the blog. We've got a lot of educational material there as well. And I think that about does it for this episode. They go so fast, folks. We will be back next week to bring you all of the latest news and updates that you need to know as a Fed in order to make informed decisions about your career and your financial well-being.
Be sure to subscribe to this podcast on Spotify and YouTube so that you never miss an episode. And please remember to share it with your friends and colleagues.
Absolutely. And for more information on the topics covered in today's show and more, as I was saying, check out our blog. You can get there at stwserve.com. If you want to go there directly, blog.stwserve.com will take you there. While you're there, go ahead and subscribe to our newsletter, The Weekly Serving, to get all of the latest news for Feds delivered straight to your inbox every week.
And for those of you who want to dive even deeper into learning about your federal benefits and financial planning for Feds, we encourage you to join us for one of our complimentary webinars. We have a FERS webinar coming up on Thursday, May 2nd at 1 p.m. Eastern. And if you have any questions about how to best allocate your TSP or any other TSP questions in general, please check out our next TSP webinar on Friday, May 17th at 11 a.m. Eastern. Or if you prefer a one-on-one approach, feel free to reach out to our team directly for a financial planning consultation at askstws@stwserve.com.
Absolutely. Thanks so much for listening to the Fed15, guys. I am Katelyn Murray.
And I'm Chelsea English.
And we will see you next week.